Hello, everyone. It's time for Swim with Jim. Hello, everyone. This is Jim Ludwig from Main Street Financial Planning. We're glad to have you with us today. We have another exciting interview, and our guest is Mac MacKillop from First Ascent Asset Management. I hope I didn't butcher your last name, Mac.
Nope, you got it right on. I'm doing great, Jim. Thanks for having me.
Well, today our topic is using simple portfolios. And we're going to ask you a number of questions and talk about what you and the people at First Ascent Asset Management do. But let's talk about, and let me briefly tell our audience what a simple portfolio it is. That's usually 3 or 4 index funds or exchange traded index funds that develop into 3 or 4 asset classes, and you rebalance those periodically. They're very cheap, and it's no big deal. And the Bogle heads, the people that follow John Bogle, promote simple portfolios quite often. And I thought we talked to an asset manager that does index funds. So, Matt, should we talk about active versus passive first of all before we get into simple portfolios?
Yeah, absolutely. I think that's a good place to start. So there's a big debate in the financial services world between the active management and the passive management camps. And really what that means, passive management is when you are investing in an index or a benchmark like the S&P 500, which is the one that everybody knows, really where you're looking to buy a broad group of securities, of stocks or bonds. And the underlying philosophy is really that it's difficult to pick winning stocks. It's very hard to beat the market. So instead, you find a cost-effective way to just buy the market as a whole. Active management is really the opposite of that. With active management, you're trying to pick individual stocks, trying to pick individual bonds, something like that to try to add value, increase returns, or beat the market overall.
So tell me now, what is a simple portfolio? And when does it go beyond being simple?
Yeah, so a simple portfolio, really the idea there, and you did a good job of explaining it initially. There's a number of ways to put it together, but the philosophy is that you are seeking to reduce the costs and the turnover as much as you can within a portfolio. Usually that means holding fewer funds, it means trading less frequently, and really focus on getting broad diversification and low cost. And what we found from a lot of the research that we've done and that we've seen around the academic industry as well is that simple portfolios over time create better investment returns and results for investors.
Mac, we have a lot of our clients who are do-it-yourselfers, and one of the things that always concerns us that maybe the portfolio is getting too big and a mistake can be very costly as far as in whole numbers, or that people are getting older and may not be exactly on the top of their game anymore. So when should a do-it-yourselfer hand over their portfolio to an asset manager that does simple portfolios or even more complex portfolios than that to an asset manager like Ascent Management?
Yeah, absolutely. So I guess there's really a couple of reasons when you could turn a portfolio over to a professional manager. One of those would be if really you just you're tired of taking care of it. The example I like to use is I could probably paint my own house, but I would prefer to hire a professional to take care of it. So that's something where just the upkeep of a portfolio, which can take a lot of time. Rebalancing portfolios to keep them at a set level of risk, doing research and due diligence on the funds, even if they are simple index funds, it's still important to make sure that there's the liquidity that you need and that they're being traded in the right way. So really just, hiring a portfolio manager as a service. There's a lot more low-cost providers of really quality portfolio managers out there today than there have been in the past. And then the other one would just be if you don't have the expertise. Particularly if you're going into retirement and you need to do a little bit more planning around taking income, or if you or just want to outsource to somebody who has, they spend all day doing due diligence on funds, researching trading practices, things like that, just to make sure that even though it is a simple portfolio, there are still a lot of important decisions to make, and those decisions can have real consequences to investors.
So tell us, when someone comes to First Ascent and they're thinking about using your service, what are the questions that any consumer should be asking a potential investment manager that does a passive strategy like you do?
Yeah, absolutely. Well, I think one of the first ones just to ask any investment manager is how they're getting paid. And this happens less in the simple and the indexed world, but there are a lot of asset managers who, I'm still amazed at how many people think that they're getting asset management for free at Goldman Sachs, because the fees are just so embedded into the products and there are so many kickbacks involved. So I think that's the most important thing, is just understanding the fees and the costs at every level. Beyond that, really just getting a sense for the team and the experience, making sure that they're a firm that's been doing this for a long time, that has a clear philosophy that aligns with yours, and that there's a team in place that's going to be doing the work and the due diligence and making sure that they have your best interests in mind. Sorry, go ahead, Jim.
Now, does the SEC mandate some sort of disclosure document that people should ask for?
They do. So there's a lot of disclosure documents that you can ask for. Every investment management firm like ours has an ADV brochure that has to be filed with the SEC or with your state regulators. So that's really probably the first thing to ask for. It can be kind of long and dense, but it really is worth reading through that document just to make sure that whoever's managing your money, that you understand who they are, you understand how they work, and how the fees are coming to them.
What other things should they ask for?
So beyond that, I think it's important to ask for information on the personnel, finding out who the team are, who their experiences are, and finding out about their investment philosophy as well. So making sure that the way that the portfolios are built are something that's going to be a good fit for you going forward, and that there aren't additional funds or changes in the strategy that could happen over time that you wouldn't be aware of.
Let's talk about fees for a minute. What is the range for passive managers versus active managers? Can you give us a range, not just your firm, but the firms that you compete with, et cetera?
Yeah, absolutely. So in terms of the funds themselves, the index funds or mutual funds, or as you said, exchange traded funds that are used, there really is a lot of price compression that's happening in that part of the market. So you can get really good, broadly diversified index funds for as little as 5 or 6 basis points, which is 0.05 or 0.06%. Really on the passive side, things range from about that low up to potentially 15 to 25 basis points, so even 0.25%. And those are generally low expenses for investing. In the active side, it can be all over the map. You can have some strategies that are as low as 20 or 25 basis points, some that are as much as 1.5% or 2% for the internal expenses. And that can make a really big difference on investor returns. So that's definitely something to look for. The fact that there are a little higher expenses in some strategies doesn't necessarily mean that they're bad. But overall, in terms of the way that the portfolio is put together, a pretty good benchmark is somewhere in the 20 to 30 basis point range.
So there's two levels of fees, as I understand. One is the internal indexes the manager might be using, and then how much for manager fees? What kind of ranges do you see there?
Yeah, as you know, Jim, that we like, because at First Ascent, we're doing something very different where we're charging flat fees. So we're moving away from that percentage of assets for what we do, and really just charging fees as low as $500 per account, no matter how large accounts become. Outside of that, to a lot of our competitors in the asset management industry, you can have fees ranging from 0.3 or 0.4% all the way up to 0.8 or 0.9% for their asset management fees to build the portfolios and to manage them going forward. And again, in that part of the world, there's a lot of fee compression, so these fees are coming down. But that is a really important thing to look out for, because it can make a very big difference in the long term on the investment results and the returns that you receive.
Are there any independent reporting on the success or the cost of asset managers? I'm thinking of Forbes magazine or Fortune or Barron's. Are there any lists where you can just go online and see what everybody's charging?
Yeah, there are, and they're kind of all over the place. The best thing to do is to you can spend about 15 or 20 minutes with a Google search, and you can find an incredible amount of really good academic research from those names that you mentioned. Also, firms like Vanguard, firms like Morningstar, who's one of the largest independent researchers of mutual funds in the country, and they produce a lot of white papers and a lot of research looking at active versus passive management. Looking at individual fund companies and the results there. And there's some really interesting things that you can find. My favorite is a study that Morningstar did not too long ago, where they looked at every single mutual fund in existence, essentially. And they ran them against every factor that they could find to try to say, what's predictive of good returns? Is there something that we can find ahead of time that will tell us if a fund will perform well? And what they found is the only thing that has any real predictive ability is cost. The lower cost funds outperformed the higher cost funds almost every time period, almost every category that they looked at. And it's really some interesting research.
Well, Mac, would you send me a link to that report? And I'll put it down in the comment section so people listening or viewing this broadcast can follow up on that, because that sounds like something that every investor should be reading if they're really looking into investment management.
Yeah, absolutely. I'll send that right over. And if anybody has any questions, you can always find us as well at First Ascent Asset Management, and feel free to reach out.
Great. Any final thoughts for our audience before we leave today?
I think the general idea is, complexity is expensive. And financial services are an interesting part of the world. It's one of the places where the more complicated something is, the more expensive something is. A lot of times the less value you're getting. And that seems like an oxymoron to people, but it really is one of the guiding principles that you can keep in mind when you're investing your money to make sure that you achieve your goals and you get good results.
Well, we certainly want good results and to meet our goals. And thank you very much, Mac. We've been talking today to Mac MacKillop of First Ascent Asset Management. You'll find them on the internet. They're headquartered in Denver. Anyway, thank you, viewers and listeners. We're glad to have you here. Be looking up those simple portfolios, because as Morningstar and other researchers tell us, that cost is very predictive of doing well as an investor. Thank you, everybody. And Mac, thank you to you.